The entry rules on our butterfly are relatively simple, and it's all based on asymmetric risk to reward, asymmetric returns. And so we found that the sweet spot in asymmetry, after hundreds and hundreds of trades, we found that it's right around 8.8, 9, 9.5, right around there. That's the risk to reward. So if you were to look at any particular butterfly, the easiest way to get a 1 to 9 would be to look at the width of the fly and then make it cost 1/10 the width. So if you had a 20 wide fly, then it should cost $2. If it was 30 wide, it should cost $3, etc. Now, how far out of the money is that? Inconsequential. Sometimes it will look like it's way far out of the money, and sometimes it will look like it's much closer to the money, and it will be the market really pricing that in for you. So there's no real thinking that you have to do there. You don't have to say, well, you always put it like three strikes out of the money. But that's just the wrong way to go, because if you did that, sometimes you would have an outrageous risk to reward, and other times it would look okay. So instead, we have found that sticking to the risk to reward formula gives you more consistency over the long term. So that's the first step. So let me just review that entry rules. And these rules are, like I said, born out of hundreds and hundreds of trades and what works. Over the past couple of years in a bull market, this has produced anywhere from 10 to 25% return per month. And in the bear market, it still did well, producing anywhere from 3 to 7% per month. So pretty simple. We like to have the wider the better. I found that 15 to 30 wide. If you're using the XSP, then it would be between 2 and 4 wide, because the XSP is 1/10 the size of the SPX. And this would also apply for the E-mini S&P, even though in reality, it's half the size of the SPX. Still, I would even say that, I would prefer to say that should be 20 to 30 wide. That's better. Or maybe even 20 to 35 wide. There you go. Like I said, these aren't rules. These are more suggestions. But I'm just going by what the data says. Now, this thing here, which way do you go? So if you're just trading the single classic out of the money symmetrical butterfly, do you go bullish or do you go bearish? And a lot of times we really don't know. When I was first developing this strategy, I would often say that you have to develop a directional bias. You have to do all of this macroeconomic analysis and try to figure out which way the market's going, and then put, your fly on that side of the market. Now, last year, that was an easy thing to do. And it had nothing, you mostly went bullish because last year everything went up. And occasionally you had a pullback, and then you'd go bearish, and then you go bullish. So when the bear market started at the beginning of this year in January, I tried that same methodology, and it just wasn't working. Last year, making anywhere from, 10 to 25% return a month. It seemed like you could throw crap against the wall and it would stick, and everything was cool, and then the wall would clean itself. So, but this year, completely different story. And what I found was, where last year I had anywhere from a 65 to a 95% win rate, month to month, because the market just went in one direction. This year, the win rate, with all of that work and all of that effort to try to figure out my market bias or my directional bias, still only about a 53% win rate. So what that was telling me is that it's all crap, right? It doesn't matter. So, obviously, if you can be a little bit over 50%, that would be great. But the reality is that you could have a win rate as low as 35% and still have a good positive return. When you get up to the 50, 55, or even 60% win rate, this strategy starts, shooting off into the stratosphere in terms of return. So if you can just do 50% win rate, you're really ahead of the game. My advice would be to just use something, whatever's in your basket of tricks, wherever you think whether you should be bullish or bearish that day. And probably the easiest way to do this is to maybe look at a 50-day EMA on maybe an hour chart, and then when it's above there, go bullish. When it's below there, go bearish, I guess, Quite frankly, even if it goes against you that day, because you have such small risk, it's not going to hurt you. And often when it goes against, it then comes back and you end up profiting anyway. So that's what I would do. I used to think that developing your directional bias was absolute. Now, I guess it is if you're in a bullish market, but then the same rule would apply, right? If you're above the 50-day EMA, go bullish. If you're below, go bearish. And if you're above it, put on a call fly, a long call fly. If you're below it, a long put fly. Again, that doesn't make that much difference. However, if you get too far out of the money and you're on the wrong side with a put and a call, then your pricing may be a little wonky.